I've got Tom Lee on the phone now. Let's listen to see what Tom Lee has to say about the recent rate cuts, where we're going, and it's all part of our gold series. Watch to the end and you'll get all the links for the others in the series. We've got FOMO, cheap money, S&P, Nvidia. It's a gold day today. We're breaking records left, right, and center. As you can see, my balance is now $116,000, all from $5,000. And now let's go over to Tom Lee.
A lot of uncertainty, and that's the reason why I'm a little hesitant for investors to dive in. But if I was going to advise where to be positioned, Carl, it's exactly what you said. It's cyclicals, which is industrials, financials, and small caps.
Right. With a preference for that over your traditional Mag 7 tech AI build-out trade?
I think tech and Mag 7 still keeps up with the market. And that's why if someone owns it and they have tax implications, I wouldn't sell it. But for all these folks that have been sitting on defensive positions or thinking the Fed cut was going to be too late and the market was going to, equity markets were going to fall, I think those folks have to allocate into cyclical stocks, especially small caps, because they are not only sensitive to the cut in rates because of variable rate debt, but they're going to benefit from the cyclical boost to the economy as mortgages. The cost of mortgages drop, auto loans, credit cards, the lift to the consumer, potential M&A, all these are big tailwinds for small caps.
I guess then the risk to this, Tom, is that inflation comes back, right? If you're talking about this big cyclical recovery because of what the Fed's doing.
That's true. But I think one thing investors have to distinguish is that real growth, like GDP growth, doesn't mean inflation pressures, because inflation is, a mismatch of supply and demand. And I think there is a lot of excess supply potentially coming. For instance, housing could have a supply response. And if you look at the two biggest drivers for inflation for the past 8 quarters, it's been shelter and rent rolls and auto insurance. And auto insurance, I think these insurers have reached sufficiency, so you're not seeing the premium increases anymore. So unless the rest of the CPI basket accelerates, inflation is actually falling pretty sharply.
Hey, Tom, on the labor market, we're going to get two prints before the November meeting. Some of these doves are arguing that labor is going to force a faster pace of cuts because historically they argue the change in monetary policy doesn't get felt in the labor market for 4 quarters, and the peak impact is not for 8 quarters. I wonder if you agree.
I mean, I don't think there's anything wrong with people looking at the history of labor markets, especially as people know, as labor markets slow, it has a cycle of its own. The one thing that I think we have to keep in the back of our minds is that CEOs have been cautious for the last 2.5 years because the Fed telegraphed a tightening cycle to fight inflation. So I think that the fact that rates and now we're in an easing cycle means that companies are going to actually start doing expansion. So I think the labor market and the Fed is mentally knocking down these monthly numbers. I think tailwinds are emerging for labor markets to actually strengthen.
Yeah. Well, claims would definitely back you up today at 219, even though some argue about seasonal distortions. Tom, look forward to talking in person soon. Tom Lee this morning.
Thank you.
There we go. Tom Lee on the phone talking about the S&P, talking about the global markets, talking about everything together. Really do appreciate that. Some great stuff there. This is all part of our gold series today. We're doing a playlist of gold videos. Go and check out the whole playlist. There's FOMO, cheap money, the S&P, Nvidia as well. Click above my head for all the links down below in the description. Over here, I shall put the playlist for the gold, and down here, the psychology investing. Watch it over and over again until you get it into your head. I'm really serious about that. I'm being really blunt about that. So there you go. Until next time, as always, take care of yourselves and each other.